Welcome to the Broken Pie Chart Podcast, episode 262. Yes, it is 262. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, what's going on today?
I mean, I'm a broken record. This is the 8th time in a row I'm saying we hit a new all-time high, and we closed at basically at the high right now, right? It's a very interesting number here, but besides the very first week, 8 consecutive weeks, Derek. This is kind of the market is looking strong.
Oh, that's really insightful commentary, Jay. That's
strong market, new high. Strong market, new high. Strong market.
You're really bringing it to the audiences.
I gave them something they hadn't even thought of right there.
Yeah, it's so you and I have been joking around making and we don't think predictions are really worth anything. That's why we buy, we hedge. We don't know necessarily what market's going to do, but we want people to be invested, be buffered, be hedged. You and I jokingly, I think would we say by April, I said it was going to 51.50 and you said it would hit 49.
No, we didn't even pick a time. It was which happens first, 49.
Oh, that's right.
51.50. And we hit 51.43. Like You're right there, Derek.
Yeah.
Look, I want you to be right. Generally, we're happy when the market goes up. I mean, there are times where we have positions on that we go, whoa, ease a little bit back, market. But generally, up is really good, and we're generally, bullish bias. So yeah, this is great. I hope you win. You're so close.
Yeah,
you're so close.
It's promising. 140. It's promising, as our head of trading, Mick Brokaw, would say. I mean, it's promising.
If we were to drop to 4,900, right? Let's just say it's 137 that would be a 237 point drop on the S&P 5137. That would be a 4.6% pullback. I don't think anybody would get worked up over that, but it would feel like, whoa, that feels a little serious. But I mean, I've said this word a million times, and when I re-listen to our podcast, I say I have to stop calling it a monster. This market's a monster.
It's strong. Yeah, that's strong. The other thing that comes to mind is everyone keeps pointing to the Magnificent Seven. I'm not even going to get into that because I'm tired of that discussion. And one of the things I did was I found Charlie Bilello posted something on Twitter, largest U.S. companies by market cap, 1960 to 2024. And the ones right now are Microsoft, Apple, NVIDIA, Amazon, Alphabet, Meta, Berkshire, which, by the way, I think I haven't looked lately, but don't they hold like half Apple? So that sort of should go to
taking some off. They just had their quarterly meeting. I think they're starting to take a little bit off. Well, yeah. And Apple, by the way, has not been the driver.
It's not. Eli Lilly has certainly helped, and they're in there. Tesla, Broadcom. Jay, let's go back to 2000, and it's Microsoft, General Electric, Cisco. Remember, Cisco was going to be the picks and shovels of the internet. That was going to, Walmart, Exxon, Intel, Lucent, IBM, Citigroup, AOL. I'm not going to go through all these, but the point is, by the way, you go back to 1960, AT&T, GM, DuPont, Exxon, GE. GE it was a big company. Here's an interest. Let's look at GE for a while. So GE in 1960 is in the top 10. GE is in the top 10 in the 70s, 1970. In 80, it's in there. In 90, it's in there. It's number 2. 2000 is number 2. 2010, it's still in the top 10. I don't even know where GE is right now. It's fallen out. But
it's probably not even in the top 100, right? So
yeah, I mean, this is the point, though. It's this index is going to, as companies grow and they become larger and larger, they're going to take over the top spots on the index. So I got to hand to Microsoft, though. Number 1 in 2000, number 1 24 years later. That's something, I guess, right?
Yeah. You look at the Exxon, by the way, also many, many decades in the top 10. Not there now, not there in the 2020. So, but the other decades, 1960 through 2010, it's in this number 1 in 2010.
Yeah.
This is such an interesting thing to look at, right? That the stocks that kind of come in and come out, hard to know how these things are going to migrate. When we talk to the Gen Zers, right? They thought, why don't I just own Apple for the rest of my life? They may have a couple decades left of Apple, but For if we were doing this podcast in 2080, so Derek, at that point, you're 110 years old and we're doing
Yes.
this podcast, Apple's probably not in there. There you go. That's the prediction. We'll see if we're right in 2080. Apple's not in the top 10. There you
2080 when I'm 110. Yes, that's exactly what I'll be doing. I'll be doing just podcasts. That's the only thing I'd be able to do.
Show number, 50,000 or something for you. Right?
Something like that. I don't know.
That bad. Fun stuff. Yeah, it's amazing, right? It really is. It really is kind of great. And when you look at this list, right? Microsoft, Apple, NVIDIA, Amazon, Alphabet, Meta, Tesla. So we just rattled off 8 NASDAQ stocks, right? NASDAQ hit an all-time high as well. It took a little while for it to get there, but new high for NASDAQ this month as well. So
congratulations, NASDAQ. Good job.
Yeah. What's the Russell doing? What's the problem? What's the problem, Russell? You're not even close, right?
Well,
high 2458. It's at 2078.
The argument is that those companies are most dependent upon debt and they're most impacted by interest rates, which kind of brings us to our next point, which is, and I'm just going to say it, I'm tired of this discussion on the Fed and whether they're going to lower rates. Like at this point, do you really want the Fed to lower rates? Because if they lower rates, it imputes that there's some sort of upset or problem in the economy. Like, just get over it. Like, I don't. There's no reason for them. I mean, let's look at the PCE Supercore, Jay. And by the way, it's
what is the Supercore, Professor?
Oh yeah, so Supercore is basically X food, X energy, X housing. And
X those 3 things. Got it.
Yeah, if you don't get what you want, you keep stripping stuff out until you do. It's like the chart time frame. If you don't like the 10-minute chart, go to the 5-minute chart.
One of the best Derek quotes ever. Right?
Yeah.
Hey, you don't like that chart? Change the time frame. You'll find it.
PCE, by the way, is they say it's the quote unquote Fed's preferred measure. It's a little bit broader, and PCE includes things like. Let's say an employer purchases services like insurance or things like Medicare. It includes things like that in there. So CPI is more about what households are doing. So they're a little bit different, and PC is a little broader. But this idea, housing, and I think the reason why this is coming up is people say, well, housing is lagging and it's going to come down eventually. But so PCE Supercore, core services, excluding housing, is measured by personal consumption expenditures. That's what PCE stands for. Jumped by 0.6% from December to January, the largest monthly increase in more than 2 years, Jay. And by the way, Supercore expenditures account for more than half of the weight of the PCE core bundle. And this is, I'm sure you follow, as I do, the Kansas City Fed blog. I know that's on your list to check every morning.
Yeah, sure. Those guys are great.
Yeah, absolutely. So come on, give them a break. They're good people over there.
Sure.
So
they listen.
Yeah, but you look at this though, and yeah, I mean it's.
So let's just say that again, right? Because everybody is assuming we've licked inflation, right?
Yes.
But the data point that the Fed, one of the
Kansas City Fed
uses, right?
Yes. Yeah.
Had its highest increase in 2 years, in more than 2 years in this past month, right? The December to January jump was the highest increase in Supercore prices. I don't think people are talking about this at all. You tell me why we're at an all-time high, Derek, when you're getting inflation on the rise. Is there a seasonal component that gets you to blow this off? Go, no one's paying attention to Supercore. Is there, when you look at this kind of information, what makes you think the Fed's going to cut it all?
Well, I think if the economy is fine, why would they cut? Like, why would they waste it? They want to cut when... I mean, here's the thing. Let's say that the economy is fine and inflation just goes back. The CPI, regular CPI year over year, including everything, just goes to 2 to 2.5%. If the economy's fine, why are they cutting rates? I mean, why are they doing that? zoom out a little bit, and you've got the chart there. This is a longer term chart of the PCE Supercore, and you'll see it has been trending down, meaning the year over year. What was it right now? What was it a year ago? The month print was a little bit hot. And this is a little, kind of a trick that you can do with charts. If I compress this and I show just a little bit of time, I say, well, it's coming down. Like you see the one I sent you, Jay, a little bit, the one right above it. It's like,
Yeah,
it
this
is
thing's a
trending down.
wonderful eye chart. Thank you. If I'm blind, I'm blind now. This is a
Yes,
lot of data going on
it's
here.
fantastic, but it's yes. But and then you zoom out and you say, well, actually, going back to 2014, 2015, I think 2017. I mean, PCE Supercore, and people will make fun of us for bringing this one up. But look, people are doing it on the news. You don't like everything in there, you use another one. It's still sort of elevated. So I think the point of all this is the idea that inflation is back to where it was, and I don't mean prices are back to where they were. I mean the rate of change, the rate of increase every year is sort of back to where it was. It's not quite there yet, Jay. And
It's
I think
definitely
that
not there. It's definitely not there, which is so. Look, I could think of probably a handful of reasons why the Fed should cut if inflation was at 2% and growth was fine, right? I could think of some reasons.
You want to goose the housing market? Is that in commercial real estate?
Well, sure. I mean, you could. Well, you and I both think that it would stop the inflation in the housing market itself. It would make housing more affordable. Servicing our national debt is something they're going to get pressure on, right? Rates at 5 versus rates at 0 just cost a lot more to service our debt. That's probably a more political conversation, which I won't get into. I could also think of if you're so far ahead of inflation on your main rate, they don't like that to get too far away, right? They like bond treasuries to be 1.5% to 2% above inflation, right? So if you're 3 plus, I feel that that's an area where they're uncomfortable and they just would think that rates are just too high. So I don't know. Those are 3 reasons. I'm not saying they're all valid, and we could have an argument there, but I think they would take action if all of those started to make sense to them. But you first have to make sure you're not causing kind of the double pop of inflation. And based on the data you're showing me today here, Derek, seems like inflation is not licked. It's not even close. The rate of change isn't close to the pre-pandemic levels. There's a long way for them to go. They're not talking about it in all these terms, but this is data they see, obviously. So they're digesting this.
I do wonder if they'll do something close to the election. I don't know.
I was at a conference this week in Nashville and ran into a lot of folks that do believe this time around, there's probably going to be a lot of things that happen around September, October in timing with the election. And I'm not a conspiracy theorist. I'm not the person that thinks the government manipulates things. But look, when you're in an election and you have the chance to have something impactful, do you want it in March or do you want it in October and September? You want it then, right? So, be of recent mind in the mind of your voters, right? So, but I don't really love those arguments. I don't like going down that path at all. Too many if-thens.
What's the 10-year Treasury today? It's what is it, like 4.2, right? Right or about there. The 10-year.
In a second, but go ahead. I could have prepped that for you, but I got it. Well, I'm gonna get
it. So here's the other thing. If the Fed, we just said, why would they do it? They'd help housing. I mean, typically, and you know this, if you take about a 4.2% 10-year Treasury and add
4.18, so you're right. 4.2 is good enough for
all right. Close enough for government work.
I'm giving it to you. You got it.
Yeah, so I like that. So let's say, here, let me do some quick math. What's 420 plus 150 is what, 570, and 170 plus 420 is 590. Okay. What I'm just doing there is, let's say the Fed cut rates to, I don't know, whatever it is, 4% tomorrow. If the 10-year is still around 4.2%, typically there's a spread between what the 10-year yield is and what mortgage rates are. Historically, I think it's anywhere from 150 basis points to 170 basis points. And so, it's not like interest rates are going to go to 3%. Interest rates, they should come down. I mean, right now, I think it's about 6.9% of 30-year mortgages. So there's probably a point, 100 basis points that is left to come out of that if it just normalizes. And this gets into
it's a good point because, remember what the Fed impacts is the risk-free rate, right? The overnight rate. They don't impact the 10-year. We know it all ripples out, but they could cut 100 bips and still be higher than the current 10-year. I think that's your point. So they would not necessarily influence mortgage rates by cutting. I think that's the point.
They may not.
Remember, that's the thing about bonds, right? It's time and rate that matter, right? And that's what caused it to be a multi-dimensional asset in my mind, right? You have to think about all of those things. I think I challenged you last week, and I don't think we did it here, which was, how long have we been inverted? I'm sure that's something that we could dig up. I think this, continues to stretch for a while. And you're right. If they cut rates, that 10-year might not move at all. It just might not move at all.
I think it was July of 22.
So we'll probably pass 2 years of being inverted.
I think so, yeah. But remember, though, who inverted the curve? It was the Fed. Who will uninvert it? It will be the Fed. I mean, and then you say, well, why would they raise rates? Because they want to cause a recession. Why do they cut rates? Typically, there's a problem like a recession. I mean, I don't know. Well, you mentioned bonds. Let's go there for a second, because one of the things we watch is the high yield market. Jay, the CCC market, and I know you watch this one. I'm smiling.
No, we do. We have stuff in this, right?
Yeah, no.
Yeah.
So CCC, we use. We don't buy, let's say, CCCs, but we have products like SJNK, which is I think it's the Bloomberg High Yield Index. It holds a lot of different stuff in there, but it does hold some portion of CCC bonds. This is the junkiest stuff. And so one of the things I've seen recently is there's been a little bit of rally in CCCs. When I say bonds rally, it means bonds go up, interest rates go down, and they're sort of related there. Jay, I mean, it looks like if I make my screen a little bigger here, the yield to worst is about 12.18%. And yield to worst, by the way, is kind of like it's similar to yield to call. It's when you have the corporate bond, like if you had called away, or so it's like
you stop earning for your whole period, right? Yeah. And while you may get a better price, you would have made more if you held it. If it wasn't called away, those kinds of things, right? Because you earned interest over time. But the yield to worst at 12%.
Yeah, and it really peaked a little bit greater than 15%. Yeah, it looks like that's the end of 22. 22 wasn't a good year per se for markets, and 2020 I'll call it 17 and a half.
And the reason why when we look at this again, I'm going to reiterate something you just said. When the yield is higher, it's perceived as more risky, meaning greater chance that it defaults. So you get paid a little more, right? So the yield on these CCC bonds, the higher the yield, the scarier they feel. The lower the yield, the more secure that they feel. Secure is not the right word, but maybe the market is perceiving them as less risky.
No, that's right. It isn't. Look at 2021. I mean, I know our audience can't see this. It looks to be about, I'll call it, what do you think? 5 3/4, 6%?
Yeah, like 6. Yeah, 6%.
No fear. No fear in
2021. Well, because rates were really low, because these will be impacted by rates, of course, right? These should always be paying a higher yield than a treasury, but because they should be perceived as riskier, like you said, the junkiest of junk. Right. And so the move from 6 to 12 or 6 to 15 during the middle of 2021 through, you think that's the end of 2022, close to the middle of maybe third quarter of 2022.
Yeah. And that's rates. That's rates and inflation causing that. Yeah.
Yeah. So that means they moved from 6 to 15. That was a pretty scary time to be in bonds. Guess what? Bonds had the worst year in 50 years, and at least in 2022. Not surprising, right? So bonds, especially high yield, were perceived as riskier. It has now come down from there from 15 to 12. Trying to paint the visual picture of this.
Yeah.
talking about. But the point is, it's not. It doesn't. It's trending lower, and it's certainly not the no fear of 2021, which was the lowest on this chart back to 2000. But it's kind of in that range, with the sweet range of where it kind of hovers.
Yeah. The reason why I watch the different, so I watch triple C's, you can do double C's, C, and then double B's, single B's, triple B's. You watch all these ratings, and these are just bond ratings. And so triple C, when you get into the C rating, these are the junkiest of junk. There's a lot more risk in those than, let's say, a triple A bond. You go all the way up the spectrum. But one of the things I watched is, in 2022, if there was some credit problem, meaning risk of defaults, you might see the different ratings act differently. So the junkiest stuff might have worse, sell off worse than the less junky stuff. But to your point, 2022 is a rates thing. They all sort of sold off the same. If you look at the high yield, which one just the regular high yield. Did I put that in there, Jay? Yes, I did. Next one down. The high yield spread. And, the high yield spread right now, I think at the worst in 2022 got up to, what is that?
6.
Yeah, probably about 6. And right now it's 3.64. And what this is the yield spread. So look at the yield on the 10-year treasury, and then this is the one I'm using, by the way, there's different ones. And then look at how much more you're getting paid for across the, broad high yield spectrum. And it's about 364 basis points more yield in high yield compared to the 10-year treasury. Jay, this is definitely coming down, and it points to, I think you would say, there's not a lot of fear in the market, right?
Not a lot. No, so as we mentioned earlier, there is the high yield rate that we talked about, but then compared to the treasury in this case is what helps you understand of really how risky the market is perceiving it, right? If treasuries had a yield of 10% and the high yield was at 12, you would be like, wow, nobody's really scared, right? You're not getting a premium for taking on high yield. That's why we watch this spread, the difference between the two. So yeah, I mean, this is trending lower from where it peaked in 2022, from not peak, but when it was up in 2022 from 6 down to 3.6 today. And it's trending lower. That means the market is giving less of a premium for trading riskier vehicles than it has, a year ago.
Yeah. Is it something, by the way? I just think about the triple C chart. At the lows of 2021, you probably got the same on triple C rated junk bonds as you do right now in 3-month treasuries.
Absolutely. No, that's it. We made that swap in some of our strategies that we only need 3, 4, or 5%. We used to have to go to high yield, right? Because you couldn't get the yield in anything safer because rates were 0. Now you could go to treasuries and get very similar yield from before. So, why take the additional risk if you don't need it, right? So for some of our strategies, we've swapped out treasuries for high yield. However, others that, where it's more of a growth oriented strategy, we like the high yield position we have in those because it's, meant to be a more growth piece than a just income vehicle.
I get asked this too. I mean, we know that high yield bonds are more risky than treasuries. Of course, that's the nature of high yield. And somebody asked me, well, long term, what's the return on there? So I went back, Jay, and I said, let me look at a long term chart. And I picked the end of 1997. So this is a total return index. And let me just explain what the total return index is for the listeners. This is sort of if you bought a broad high yield index and you assume that you're reinvesting all of the, it includes the dividends or the coupon payments that you're receiving. So it's a good representation of, if you own these, this is everything that you get, and then you're reinvesting it. Jay, I looked at since 1997. The end of 97, if you bought bonds, you had 98 was a pretty good year, 99. And then you have 2000, the tech wreck. You have 2001, 9/11. You got 08, 09, the great financial crisis. Jay, you know what the average annualized return is about for the total return high yield index since
I
97?
only know because you told me, but I would have probably guessed 5 to 6.
Yeah, it's about 7%.
Yeah.
Yeah, and this is just now. There's Jay. I think you would agree. I mean, there is some volatility, and if you look last couple of years, there's certainly volatility, right?
Oh my God. Yeah, there is. Usually less, I shouldn't say usually, almost always less volatility than stocks, but the return is also less, right? So it's a good muted. There's some correlation to stocks when it comes to high yield. We've seen that over time, but you have that interest rate component. For us, our math, I think usually is 30 to 40% is interest rate driven, 60, maybe 50, 60. Somehow I got my numbers wrong there. 50, 60 is more associated with correlation to the equity markets, right? So because there's companies behind these high yields, it's not like the government backing treasuries. You still want companies to be profitable to drive the stability and the predictability of high yield. So there are pieces there. It's kind of a way to, high yield can be a way to have buffered, that term is different these days, to have kind of a more muted exposure to the U.S. market through high yield and corporates.
I wish I had pulled it. I'll do it next week. I'm writing myself a note. If you would ask somebody, hey, we don't know what's going to happen in the future. So let me throw that caveat out.
You don't know?
I don't. It's
Oh,
shocking. But,
right. So
do you want to know which stocks to buy tomorrow at the open for the best 1 minute trade? Grab a pen and paper. No, of course not. So, but if I pulled the total return index for, let's say, a 30-year treasury, people might say, well, that's obviously safer. I think I haven't pulled this in a while, but a couple months ago I pulled it when treasuries were sort of at the lows, the 30-year. I think you would have been flat over the last 20 years.
I guess the question is which treasury?
The 30-year.
If you would like, so the 30 years got all that duration in it, right? And all that risk. Sure. Yeah. Definitely riskier. So yeah, what's riskier? A 10-year, triple C or a 30-year treasury? Maybe riskier is not. What's got more volatility in it?
Yeah. And the broad high yield index is probably a duration of, let's call it, I'm making this up, but 6 to 7. I mean, nobody gives a company, a high yield company, a 30-year loan, right?
Nobody wants to lend, Bob's electronic discount store.
I was going to do Jim's Welding. That was
Jim's Welding. I was thinking Crazy Eddie. Crazy Eddie.
Oh, Crazy Eddie. Yeah. Prices are insane.
Yes.
Yeah, that's a good documentary.
Giving him a 30-year loan.
Yeah. So, but anyway, I mean, we can move on from this, but it's just, and I will, last thing I'll say, Jay, is that no one ever talks about these indexes in this way. Like if you just held bonds and reinvested them, all-time high in high yield total return index.
You're saying the high yield index is also at an all-time high.
Yes, and it recovered from the previous all-time high, which was December of 21. It's come all the way back and exceeded that.
There you go.
Yep.
Feels like the markets are going up. Have we mentioned the market might be strong?
It's
strong market?
Robust? It's promising? I don't know.
But we're going down 20% next week now that we've said that, of course.
Clearly. Yeah. Well, all right. So last thing on rates is right now, Jay, what is I know rate expectations implied by the Fed funds futures have come down, but how far down? Like, are we saying, what's it saying? 3 cuts, 4 cuts in the next year?
Not enough, but for my opinion, but yes. So the first rate cut now looks like the market is pricing in for June.
Yes.
For a cut in June. And then by, let's say January of 2025. So let's say, not a full year from now, 3 more cuts from there, 3 and a little bit. So yeah, it looks like 4 cuts, 3 in 2024. I'm going to say 3.5. I know that just the way the market goes, you don't go in exact whole numbers, but like 3.5 by the end of the year. So that was like 6 a few weeks ago,
yes.
Right? And you and I were scratching our head. So this feels a little more muted. I'll put you on the spot, Derek. We did do predictions. What were in our predictions for how many rate cuts? We'd have to pull that up. I don't recall. I'm in they got to do at least one camp,
I think I was 2.
Yeah. Okay. Yeah. So this still seems for us, whatever that means, whatever we know, still seems a little much, and especially after the wonderful data you provided on the Supercore. I think the market is predicting 3 to 4 by the end of this year. That was 6. The market was a little aggressive on 6 out of the gate. I still take the other side of this trade.
It's a weird thing, Jay, where let's say if they have to hike, which nobody is pricing in and very few people are even saying, that would be bad. And in my opinion, it would also be bad if they have to cut a lot for the very reasons, I won't go over that again.
Have you heard anybody talk about the R word lately, the recession?
Oh, you mean the 29 out of 30 leading economists who predicted the recession in 23?
Have you heard anything about it? Because to your point, you're right. If they got to cut 6 times, you're probably in a recession, right? Which always kind of baffled me why everybody thought the market was strong, yet 6 cuts were in the forecast. So,
well, all right. Well, it's
different traders, I guess. That's what makes a market.
And the opinions change. If let's say Friday, if that PCE report would have come out 6 months ago, it would have really hurt them. Like the market would have freaked out. Nope, no problem. No problem. It matters when it matters, right? Jay, for time to time, we talk about earnings. We talk about, the analyst estimates, and we've talked about that for the S&P. I don't know if you're familiar with this, but the semiconductors surged again on Friday, another sort of all-time high, and I forget. I think AMD had a gap up, or I don't remember what.
What AMD's running. It's trying to replicate NVIDIA, right? ARM is doing well. What was that new one that we have?
What's it called?
I'm going to get it.
Hang on. They were added to a supercomputer,
microcomputer. Yes. This chart is wild. Started the year at $300, hit 1,070. What was that? The middle of February. It's had, a pullback to 905, right? So this thing is tripled, this year, the first 2 months of the year.
All right. So super microcomputer is joining the S&P 500.
It is not.
Yes.
No.
Yes. It is. It is in there.
Market cap in 2 weeks, people start paying attention.
It's climbed past 50 billion. Super microcomputer is replacing Whirlpool. Deckers Outdoors is also joining the S&P 500, replacing Zions Bank Corporation. So it seems, yeah. I mean,
you want to know what the implied volatility of the options are on super microcomputer?
I don't even know. I'm gonna take a guess. I'm gonna take X earnings, so not around earnings. I'm gonna guess 118.
Well, that's a good guess. It's 90, down from 116. So you got the peak there. So the options are wild there. We may have a strategy that sells calls on this. We may. That does a little bit of dabbling in that. We may.
Yeah, it's and for the audience, Jay, that basically implies in the next year it could double or go to zero. Right. That's an annualized number. So
yeah, it's an annualized number. That's exactly right. Well, that's one standard deviation, right? So 68% chance that happens.
Yeah,
one of those two things happen.
Yeah, I had this in my notes, and because I saw it, and I was like, really? They're putting them in the S&P 500? But yeah. And we've talked about that. So remember, the S&P 500, the earnings, all the companies, they put all the earnings in the same basket. And so when you see these growth expectations and earnings estimates, it includes all the companies that are in there. So if you take out a company, and this is, again, why to be in indexes, if you take out a company that's maybe, I don't know what Whirlpool is doing, maybe they weren't growing as much, whatever it is, like you're adding companies who are, in theory, quote unquote, growing. So
what is Whirlpool's ticker? I have not searched Whirlpool in a while. WHR.
WHR. Oh, stock.
Yeah, the stock. Yeah, it is, it's still $106, but it is at the bottom of its chart. They must not make chips or have any Bitcoin in them.
They
Or
haven't figured out a way for
Whirlpool hasn't developed their own AI for washing clothes, I guess.
I'm shocked. Let me look at their financials though. What's their people are like, really, you guys gonna
Sorry, we just got down a rabbit hole here. But
yeah, so
interesting. Little head and shoulders.
16.2 trailing 12 months a revenue, 19.4. Is this in millions or billions? In thousands. So 19 million, and it's in thousands. So 19.4 billion in revenue. And what is Micro Supercomputer's ticker?
SMCI.
All right. Super microcomputer. Let me look at their financials, and let me go
that's
to
an oxymoron of a name, but I guess it's, we're really micro.
Yeah.
So good, we're super micro.
Super. It's like batteries plus, plus what? What else you got? 9.2 billion. It looks like trailing 12 months revenue. So,
but yeah, interesting. I don't love that Whirlpool chart. They really need to develop some AI.
They should do AI. Remember in the 2000s, Jay, if you just put a .com in the end of your company, you had like a 40x.
Clorox went bananas. We have a website now. What? Clorox doubled.
It's classic.
They got a website.
All right, let me just talk about the SOX index.
We got off track.
Yeah, the Philadelphia Stock Exchange, the Semiconductor Index. Jay, you always make the point, and I agree, that earnings or stocks are forward-looking. They look at what's in the future. So semiconductors made a new all-time high. They surged again this week. And earnings per share, the growth, the forward 12-month estimate is growth of about 9.82%. The forward 24, so the next 2 years, basically, the growth in earnings is about 35.29%, and over the next 3 years, 17.43%. So, the growth isn't crazy this year, although who knows if NVIDIA keeps blowing out their earnings. It's basically saying that they see strong earnings growth, or at least the analysts do, over the next couple of years. So it's forward looking, right?
That's what, if you think it's going up over the next few years, you want to get in early. I've had a lot of conversations with people about some of the tickers we've mentioned before, and it's, you may never be able to buy NVIDIA at $500 again. You just may not, because of all the projected growth. Of course, you put it on your buy list when the market has a major sell-off, people, just everything goes down. It could be one of those scenarios. But things like this, where the projected growth for the forward +1, which, like you said, is 24 months, is, it's strong. And so this market moving today is based on stuff that hasn't happened and won't happen for 2 years. That's really forward looking.
Look at the forward 12-month. That's the forward price to EPS forward 31.8. The forward 2 year is 23.5 forward P's. So I don't know.
A lot of growth projected here. But we have an investor that just says, doesn't everything have to have chips in it? Like what are we going to have that doesn't have chips? Hey, even washing machines have chips in them. Whirlpool has chips. Going back to that fun theme, right? Like, what doesn't have chips in it, right? That's the concept here of why, you think about this. When I think back to tech, right, before the S&P split up the different sectors of a lot of the stocks, right? Google was a tech stock. Amazon was a tech stock. They're not anymore, right? They're communication, consumer discretionary. But tech was this kind of soft tech, right? Which was more like software, services, those kinds of things. But now, you've got the larger part of it is the semiconductor. Maybe not the larger part, but a significant portion now is semiconductors. Tech is physical tech. There you go.
Yeah.
How many chips are in your car? We should Google that. How many chips are in my car, I wonder?
Probably too many. Probably too many.
That was a problem, right? During the pandemic. Couldn't get enough chips. which is why, right, there's a lot of effort to bring this onshore, a lot of government programs to bring the foundries into the United States versus, Asian companies that are producing a lot of chips we use today.
All right, I'm gonna try and stump you.
Okay.
And Cisco Systems,
Okay.
which and you can Google, that was called the picks and shovels of web traffic. Back in the .com era, it was like, hey, this is going to be the biggest stock in the world. It's because they were networks, right? It was internet traffic and networks and all that stuff. Have they exceeded their all-time high from 99 2000?
I mean, my guess would be yes, but
I'm setting you up here on purpose.
Yeah, I know. I know. Well, you would guess yes because all the growth and the chips. But you know what? It could be an example of where forward expectations were just way too darn high. So, like, you're going to do like the early 2000 all time.
Look at the chart.
Yeah.
Look at the chart. And so it looks like it got to about 80. I'm going to say that's probably March of 2000, though I don't know the exact date. And in 2022, it looks like it got over 60. So it has never exceeded its
it hasn't got
2000.
Back. And that's Cisco. They're big. Yeah.
Yeah. And I don't know what NVIDIA
not
is.
even at a recent high. I mean, I guess I could have been. I'm really wrong here. Right? It hasn't exceeded its high of what is this? July of 19?
Yeah.
Yeah. Didn't really pass that. So
no.
So I failed the quiz today. Gosh.
It's
you're gonna ask me their market cap or something. Which
No. I wouldn't do that. My guess is it's probably half. I guess the reason I just thought of that, I went down that little diversion, is NVIDIA right now is considered the picks and shovels. I mean, these tech, the semiconductors and everything. You and I don't know what's going to happen in the future, but I remember in the late 90s, they said the same thing about Cisco. They said the same thing about a lot of companies. I don't know. We'll see what happens. I'll let you know when it happens. How's that, Jay?
Great. Well, we are going through this AI boom, right? So we'll see.
Apparently, yes. All right, let's switch to VIX. And I was in a discussion with some institutional people this week, and the question came up. A lot of people try and trade VIX, and by trading VIX, you can either. All right, let me set this up. When you trade VIX, you either have to buy the future, and you could buy a future that expires in 2 weeks. You could buy one that expires in November. Okay. And when you see the VIX index on your TV screen, there's no way to trade that. That's the spot. You can trade options on the VIX. The options are on the future. If you're buying a November option, you're not buying it on the near term one. You're buying it on that contract that's in November. But Jay, I think this is an interesting discussion because the question came up, and it's the thought is, most people who have traded VIX or in the in the derivatives and options world like we are, would tell most people, and especially novices, don't try and trade VIX. And the question was, why is it so hard? If somebody said, okay, and I'll pose this to you and I'll come in on it after. If I think that the market's going to have some problems between now and the end of the year and VIX is going to spike, why is it so hard to play that?
Okay, so the thing with the VIX is, as you just said, the only way to trade it is going to be futures based, and that's okay, that's fine. But what you should realize about a futures based trading product is it's about price and time. So what do I mean by that? So today, Friday, the VIX closed at 13.11. If you look at the March futures, they're priced at 14. So just a point higher. And you may say, okay, that's not so bad. Like if there's a little bit of a problem, the VIX would pop up. Yeah, I think the VIX would get over 14 between now and let's say the next 18 days. What happens though is even if the VIX pops, it has to stay that high going into where that future will settle. So the futures may say, yeah, the VIX has popped, but it's probably going to pull back, right? We reference this as the VIX futures being lazy compared to the spot VIX move, right? It's a probability bet, right? It's you have to have, in this scenario, the VIX not only pop between now and then, but be higher than 14 for you to break even in this scenario. So you could get the spike, and you could absolutely be right. The VIX can go to 18 next week, but the future will not appreciate that much, even with that short period of time, because the future market may say, yeah, but it's not going to end at 18. It's hardly spent any time at 18 this year. It's going to pull back maybe to 16, right? So the futures will price based off a specific point in time and where the VIX will be at that time. So that's the hardest thing about when it comes to VIX trading. Like when you own a stock and you think the stock will pop, if you think Apple's going to go to 200 and you put your limit order to sell at 200 because you look at the chart of Apple and you go, that's where it's going to go. I'm not, by the way, making that prediction. Then you get to sell at 200 and you get your exit and you say, nice. But if with the VIX, you look at the chart and go, yeah, I think we could see 18 again. It doesn't mean your future is going to get to 18. You may not be able to get out there because the futures have to project that it'll get there and stay there by the time those futures get to their expiration date. So that makes it very difficult. It's not just about price; it's about price and time that make VIX futures very interesting. Derek, you want to walk through a little bit of like what happens in the futures curve? Because I just told you about March, which is 18 days away. Things look different. You go April, May, June, right?
Yeah, I mean, if you go out and there's monthly VIX futures, and then there's what we call the active one. And the active contract right now has about 18 days left. But you go out further, and in a normal VIX curve, you'd expect the near VIX futures to be lower than the further out ones. So if we go out and we say, let's look at July, it goes from about 14 up to 16.8. These are last prices, and there's not that much volume on some of the ones that are further out. But you kind of go up, August 1720, September 1767. By the way, this is, I didn't plan on talking about this, but a little kink, a little spike. October futures are 20.39 versus the November is 18.89. I don't know about, we have something coming up early November, right?
There's something that happens between October and November. Something must be going on then. Yes.
But think about that. So, yeah, so that's the election, a little bit of an election kink there. It's higher. That's an interesting one to go. So let's say somebody had the position, Jay, that, there's going to, around the election, VIX is going to spike. Okay, that may or may not happen. Who knows? So what do? Do you buy the October or the November future and you're just going to sit on it? And you're going to just sit on it. And at some point, and by the way, if the VIX goes to 25 tomorrow, that future, to your point, is not going to move to 25.
No,
it's not.
No, because the market doesn't think it'll end there by that date.
Right.
Well, it's going to pull back.
So let's say you buy the future, you buy, call it, 20 and a half, whatever it is. So let's say you buy it there. And eventually that VIX future, if the VIX if the VIX is not higher than that in November, should come down the VIX futures curve, and that should go down in price. So let's say that eventually goes down to 14. I don't know if it's going to go to 14, but let's say the VIX spot is 14 at that point. I mean, that's $6.5. That's 6.5 points, I should say.
Yeah.
That is, you're going to lose like 30%.
Yeah. That's the hard part about trading VIX. So it's fun to watch. It's fun to use it as a near-term kind of predictor of volatility and a near-term speculative vehicle. Some people like to use it to predict fear. I do not. I like to talk about it as a vehicle that predicts speculation. But, when we think about when you look at this, right, Derek, it's almost a way of seeing where the market, not only the VIX today, what it's doing, but when you look at these futures, it doesn't look like a lot of, fear is out there until you start to get to maybe what's going to happen in October. And then it's still not very high. A 20 VIX is not anything anybody's going to panic about, right? I mean, the VIX was at 22 just this past October, right? When we were kind of the bottom of that market sell off. So yeah, I mean, the VIX it's just a way to, it's, if there's any way to emotionally evaluate what the market is feeling between fear and greed, VIX is a really good one to use. I like those high yield spread numbers too, but the VIX is a really good one to use. And we use it, we watch it, right? It's something that we watch, and we look at the history of the VIX, and we look at what it does related to the options on the VIX and where the speculation is in it. So it's definitely a useful tool, but I think it's more of a tool for monitoring the market than trading. I think both you and I have paid tuition on trading the VIX.
Oh yeah,
yeah.
We've paid tuition, meaning we lost money doing what are really dumb VIX trades. This is years ago, folks. Not like in the recent history, but. The other question I get a lot about the VIX, once we establish, I remember a couple of months ago, somebody called me and they said, "Hey, I think same type of question. In the next 3 months, I think the market's going to crash, do whatever. Which VIX contract should I buy? I want to buy VIX options." I'm like, "Oh boy, here we go." And once I establish it's based upon the future, the question then comes up, well, there's oil futures, there's cotton futures, there's sugar futures. Think about that though. The VIX is a mean reverting instrument, unlike, let's say, oil, which is supply and demand. Like you could look out and try and do some forecast, and the further out contracts have what's called cost of carry in it and different things. But you could make a legitimate argument. Okay, I don't want to buy the contract right now. I want to buy the December of 2025 because I think supply and demand, and I know something in the industry, and that would sort of make sense. But with the VIX, it's not like, the VIX made a new all-time high. The VIX made a new all-time high where oil futures could do that. It's just so different.
Well, when somebody asked me, "Hey, I want to play the VIX," I said, "Why not just play the directional movement of the market, right? Buy some puts."
Well, I always say this too. Sometimes, going against, take high yield. You could buy put spreads on high yield because typically, if the market, to your point earlier, is crashing, you'd expect to see high yield sell off in sympathy. So, that's a way you could do it. You could buy, and right, by the way, puts are really cheap now on the market. Not saying you should buy them. If you want to buy them, but they are cheap in relative basis. So
one of the things, Derek, we watch, and I know I didn't prepare you for this one, but we do watch the open interest on the SPY puts, right? So we like SPY. Everybody tracks SPX, right? That's the index. But if you also look at the SPY put, which is more of a kind of a retail, do-it-yourselfer index, certainly, by the way, plenty of institutions use SPY puts, SPY versus SPX. It's fine. There's nothing wrong with them. They're great. They just have a little less. They have 1/10 the notional. So if you're doing size, SPX is a little cheaper. So when you take a look at that, I'm looking at where we are in the open interest, and we are at levels really not seen since, I don't know. Could this be right? Could this be what I was saying? Like like in 10 years, let's see. No, it's probably more like the last 5 years. So we're at kind of this high level for where puts are. So in other words, people are buying puts and they're holding them. We like to do that as a way of hedging, but to see it pop higher than where it's kind of been over the last, I don't know, couple of years, it's one of those things that make me feel like there are people who are listening and saying, look, puts are cheap, hedging's cheap. I'm happy to buy some, protection at these levels. It's kind of trending higher from what we've seen. Now, I'll also add that, think about this, right? There's so much more volume now in options than back then.
Yes.
So you could say like maybe this is really not as impactful because it's just option volume's higher in general than it was, say, I don't know, 5 or 6 years ago. But I just think it's interesting that we are seeing the volume of puts on the rise in the S&P.
I definitely watch that. And somebody out there, it's not going to be me or you, I don't think, but could do a volume adjusted sort of level of open interest, based upon the number of contracts traded. But luckily, Jay, there is something called the put call ratio, which,
what is that?
yeah, that's the number of open interest, the open interest on the puts on something against the open interest on calls. And it's the idea, when open interest is really, this is the theory, right? Open interest is really, really high. That says people are overly bearish and vice versa. Although we've got some data that actually we think the standard deviation of that ratio is more interesting to us. But so we got something on that. We got the put call ratio.
Something.
Yeah.
If anybody's interested in more, they should reach out to you, Derek. How could they get in touch with you?
Yeah, they should send me an email at derek.moore@zegafinancial.com. That's derek.moore. Z is in zebra, E is in Eddie, G is in George, A is in Apple. Financial's up to you to spell correctly. All right, Jay. Any recommendations this week?
I didn't really get to any new shows this week because I was at the conference, but maybe next week I'll be able to report back on Dune, which I plan to go see today. So hopefully I'll have a thumbs up or a thumbs down on it. Everything looks to be strong on it, but we shall see. I don't know what the forward PE ratio on Dune is right now, but I'm optimistic.
Yeah. So there's been two movies, and I didn't see the last most recent one. I do remember seeing was it in the 80s with Sting?
Sting was in the movie, right? In the old Dune, and that's right. And it was very confusing as someone a little younger watching that. So what was this spice thing? There's these giant worms, and Sting is in this. So yes, that's true. That was back then. Then there was a TV show for a little while. It didn't really make it.
How random is that? I don't know if Sting did any other acting, but the fact that he was in there.
I feel like he has, but he had a decent role, as I recall. Now I'm going to Internet Movie Database Sting's.
We need to do this live. Our audience cannot wait for this information.
Why don't you go? Do you have any recommendations?
Well, I haven't seen Oppenheimer yet, and I think it's on one of the streamers. Is it?
You haven't seen it, huh? You were spending all your time with Barbie, weren't you? Now the truth is coming out.
No, I've not seen that. That's not a movie I'm going to see ever, probably. I do want to watch that eventually. And I think is it on Netflix? There's a new movie about BlackBerry, which I saw a preview for.
I have not watched that yet either.
I kind of, those stories are always interesting to see how tenuous it was at the beginning of the company. And BlackBerry is fascinating because all of us in corporate America had a BlackBerry. I mean, I couldn't believe when those went away in popularity. I mean, we all had those, and they were great.
I missed the keyboard.
I do too. The thumbs on the keyboard.
Thumbs on the keyboard. I was a whiz. I'm not so fast on the digital keyboard.
I feel like I still make mistakes on the.
For sure I do when I'm sending you an email from my phone. You're like, oh, Jay's on his phone. That was
what would BlackBerry have had to do to? So they probably it was the fact they didn't have apps, right?
Yeah, they by the way they did have apps. We had. I'm going back to our Ameritrade days. We had a trading app. We were one of the first trading apps on BlackBerry. Actually, also the first trading app on Apple, but it's a different story. But yeah, we had a trading app on BlackBerry. I think it was the navigation of touchscreen that was really their downfall.
Probably, yeah. Like I feel like if they came out with a BlackBerry today, I might be interested in buying it. Maybe not.
Hey, somebody write that down. Sell Derek BlackBerries. Got it.
I will tell you though that I wasn't part of this team, but I'm going back to this is probably late 90s, and talking to I was in San Francisco and at a dinner, and this guy takes out his phone. It's a BlackBerry, and it wasn't even the color screen; it was the black and white screen. And I'm like, "What are you doing?" And he placed a trade. Like, what do you mean you placed a trade? From memory, he was on the test team to be able to do mobile trading on a BlackBerry. And I was fascinated. I mean, this could have been like 97 for all I'm remembering. Yeah, kind of cool.
Yeah. All right.
I mean,
I haven't found Sting has some little, spots here and there, but to Dune was one of the bigger roles for him.
Tina Turner was in Mad Max, right?
Yeah, second one, Thunderdome. So
Yeah,
second and third. But
Beyond
new Mad Max
Thunderdome.
movie's coming out. It looks great.
All right.
There you go.
All right, we have really no value to add to the audience today. We're just. I was going to tell you, don't tell me what happened in F1 either, because I taped that yesterday. One of our traders told me about qualifying. I was like, don't tell me, tell me I'm taping it. So,
there you go.
All right, that's it, Jay. Let's call it.
All right, Darren.
See you, everyone.
Next week, maybe
Take
another
care.
new high. We'll see.
All right, well, let's. Do you think there's going to be a new high?
With Van Halen, just get ready for some 5150.
5150.
You're going to figure it out.
I'll get the licensing. See you, Jay. Bye.